Welcome to the deep dive. Today we're taking a really close look at On Holding AG, ticker ONON. We are skipping the polished scripts, all the prepared remarks from their Q3 2025 earnings call, and we're jumping straight into the Q&A. That's where analysts really get to fire off the tough questions.
Exactly. The Q&A is where you find the real story. So our mission today is pretty straightforward. We're going to distill the key strategic direction, what's really driving their growth, and the financial discipline that this kind of premium brand requires. We want to see where management is really focusing their energy.
And the analysts really gave us the perfect roadmap for that. They hammered on four big themes, right? You have the incredible growth in apparel, the sustainability of their margins, whether that premium pricing can actually hold up in a market like the U.S., and what it all means for their new long-term targets for 2026. This is basically your shortcut to understanding the pressure points. Okay, let's unpack this. So let's start with apparel. I mean, it's not a side project anymore. The performance in Q3 was huge. Analysts are now seeing it as its own little growth engine inside the company. They hit a pretty big milestone, didn't they?
Oh, they did. A massive one. They confirmed they sold over 1 million apparel units for the first time in a single quarter.
Wow, 1 million units.
Yeah, and that means apparel and accessories now make up about 8% of the total business. And you can tell management is aiming to push that into double digits and fast.
1 million units is a big number. So what does that say about their ability to scale production? And maybe more importantly, where is this growth coming from? Is it just general athleisure stuff?
It's actually more specific than that, which is interesting. They pointed to strength in running, of course, but also training and tennis. The training segment is apparently doing really well in, as they put it, winning with her. So focusing on light resistance work and gym gear.
And the tennis side.
That's where the lifestyle and collaboration play comes in. The partnership with Burna Boy on the tennis line, for example, it's doing wonders for their cultural relevance with a younger crowd.
Which brings us to this idea they have. They called it a company within the company. What does that actually mean? Is that just some nice-sounding management jargon, or is there a real operational shift behind it?
No, it's a major strategic shift. It's all about distribution and profitability. They're managing apparel like its own distinct business, and it is weighted very, very heavily toward D2C, direct to consumer.
So their own stores, their own website.
Exactly. They said it themselves. That's the only way to properly showcase the full breadth of the line, how it's styled, the whole vision.
So if they're cutting out the wholesale middlemen for apparel, they must be capturing way more of the profit. That connects directly to the margins.
Precisely. That DTC model is built to drive a superior gross profit margin for the brand overall. It adds this really high-value incremental growth. It increases your average basket size, and it completely reshapes how you acquire a new customer. You're optimizing for long-term value, or LTV, right from the start.
Okay, so that high apparel margin connects to the bigger picture. Is this overall margin profile sustainable? Which brings us right to their financial discipline and that incredible GPM expansion in Q3. Analysts were really digging into this. Is it a one-time thing, or is this structural?
And that's such a crucial question. To their credit, management was very transparent here. The underlying long-term drivers are definitely structural. You have pricing power, that strict full-price discipline, the D2C channel mix, and just economies of scale. But, and this is a big but, they were careful to point out 3 temporary factors that gave the Q3 number a big artificial boost.
Okay, let's break those down. The things we shouldn't expect to see again next quarter.
The biggest one was a one-time positive adjustment, about 200 basis points. They had very prudently accrued for higher freight costs earlier in the year, but the actual costs came in way lower.
So it's like they budgeted for a massive shipping bill, the bill came in smaller, and now they get to release that extra cash back into profits.
That's a perfect analogy, yeah. Prudent budgeting gave them a nice one-time pop. The other two were, first, a temporary positive from the timing lag between their U.S. price increases and when the U.S. tariffs will fully hit them. And second, about 100 basis points came from the U.S. dollar getting weaker against the Swiss franc.
Okay, but even if you take all of that away, the underlying structural gross profit margin is still way above their long-term target. That feels like a massive validation of their whole premium strategy.
It validates everything, and that strategy requires incredible discipline, which you can see in how they manage their inventory. They mentioned that inventory volume grew faster than inventory value, and that's not a sign of a problem. It's the opposite. It's how you protect scarcity and make sure you're selling at full price. You can't be a premium brand if you're always having a sale.
Let's talk about that discipline on a global scale. Because you've got Asia-Pacific, or APAC, just exploding. Triple-digit growth, 109.2% on a constant currency basis. But the Americas, especially the U.S., is their biggest market. That's the real stress test for the premium strategy.
And what's so interesting is the contrast in their approach. For APAC, and especially China, they say they're very much at the beginning of the journey. They're getting massive same-store growth. But management is being so disciplined about store openings. Only 20 to 25 new locations globally per year. They're deliberately creating scarcity, even where demand is on fire.
So now let's go to the U.S. They raised prices in July. The single biggest risk for any premium brand is price elasticity, right? Did people stop buying when the price went up?
The Q&A made it very clear. Demand, and I'm quoting here, remained incredibly strong for our premium offerings. It just completely validates their pricing power. They know their core customer, that affluent consumer, is frankly not price sensitive.
But wait, every other brand seems to be discounting like crazy for Q4 to clear out inventory. By sticking to a no-discount policy, aren't they risking losing share even among those affluent customers? Especially if the economy softens a bit.
That is the premium litmus test right there. They're going into the biggest shopping season of the year with a firm no-discount policy. And they acknowledge it's a very price-competitive environment out there. Sure, it risks losing some people who are just chasing deals. But management believes this discipline is absolutely critical to protect the brand's value for the long term. They're choosing margin over volume.
And that kind of strength is what lets them look so far ahead. Let's talk about the 2026 targets. They didn't just meet them, they raised them.
They absolutely did. They raised their 3-year constant currency, CAGR, that's the compound annual growth rate, to at least 30%, which implies, at least 23% growth in the year 2026 alone. And on top of that, their new EBITDA margin guidance for 2025 is now above 18%. That puts them a full year ahead of schedule.
What's giving them that kind of confidence in such a volatile world? What's the fuel for this?
They said it's rooted in a firework of innovation that they can already see coming through in their order books. You've got updates to huge franchises like the Cloud Runner 3 and the Cloud Monster 3. But the big one is a whole new foundational technology launch called Light Tray, which is planned for the Spring-Summer 26 collection.
And just to be clear, Light Tray, that's not just a new shoe model, is it?
No, it's a proprietary technology. Usually this means new foam compounds, new cushioning systems. It's the kind of core tech that's vital for defending their patents and maintaining that technical edge that lets them charge a premium in the first place. It cements them as an innovation company, not just another lifestyle brand.
And that innovation speaks directly to their philosophy on capital, right? They're generating all this extra margin and efficiency. Are they just banking it?
Not at all. They made it very clear. They are continuously reinvesting those efficiencies. The lower distribution costs, the higher GPM back into the business, into things like brand building, into technology like Light Tray. And a big one they mentioned was AI integration across the whole company. The goal is basically to self-fund their own accelerated growth for years to come, while still hitting their profit targets ahead of schedule.
Okay, finally, let's zoom in on something I find fascinating, which is the shift in their customer. The brand started with, an older running demographic, people focused on injury prevention, but that's changing fast.
It really is. They said they're seeing a lot of traction with younger consumers, especially in affluent areas. They even use the phrase, the cool kids wearing ONs. And this wasn't an accident. It's a very calculated strategy.
So how are they doing it? How are they creating that cultural buzz?
It's a mix of design and partnerships. The collaborations with Roger Federer are one piece, the Burna Boy lines are another. They build this image of being modern, stylish, which is essential if you want to connect with Gen Z. They also mentioned their new kits line is going phenomenally well. That gets customers into the ecosystem earlier in their life, which drives that high long-term value we talked about. And one really interesting point here is management doesn't think they're just stealing market share from Nike or Adidas. They believe that by making these high-design performance products, they're actually growing the entire market for sportswear. They're bringing in new people who maybe never would have bought technical apparel before.
So what does this all mean? When you pull it all together, our deep dive into this Q&A shows a company that is just firing on all cylinders. You've got this dual strategy. On one hand, extreme financial discipline, which was proven out by the U.S. consumer just shrugging off price increases. And on the other, super strategic reinvestment of all that upside. That's the foundation for their confident 2026 outlook.
It is, and they need that confidence because management is also looking ahead and anticipating the full impact of tariffs to hit in 2026. That's a structural cost headwind. And that leaves a really important question for you, the learner, to think about. Management is pouring all these efficiency gains into AI and new tech. How specifically will the return on those investments directly offset those rising structural costs? Will it be enough to keep that ambitious 30% growth rate viable? That tension is going to be the key thing to watch in their announcements going forward.
A great question to keep in mind. Thank you for joining us for this deep dive into ONON's Q3 2025 Q&A. We'll catch you next time.